Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Phillip Toews, CEO of Toews Asset Management with 1.9 under management, to discuss Toews' price-reactive algorithm and multifaceted strategy that aims to hedge against sudden downturns with put options. Phillip, it's great to have you with us. Welcome to Trade Talks.
Thanks. Great to be here.
Before we get into the strategy, let's talk about markets first. With the way things are shaping up, could another sustained bear market be on the horizon?
Yeah, we definitely believe so. If you look at what's happened with Tesla stock, and that's where we've all got our eyes wide open watching first the run up in the fall. I wonder if Tesla isn't just a micro version of what we're experiencing on a larger scale in the markets altogether. It'll be fascinating to watch now over the next week or so as if we see the tech stocks hold up well. If they don't, that's been the one part that has been leading the market higher. We think that could be the beginning of the end of this bull market. We just don't think that valuations are justified based on all the lack of visibility from every front. Evictions from rentals, unemployment, and just the potential malaise if we don't see a vaccine that's widely available in the first or second quarter of next year.
So what do retail investors need to be thinking and doing?
Well, so our firm is our specialty is attempting to hedge against down markets, and it's been that way since '96 when we launched the company. And our idea behind investing is that you want to try to be there for above inflation growth in risk assets, but especially for individual investors that can't afford an extended drawdown, we believe that at least a portion of your equities portfolio should be in strategies or funds that are attempting to potentially uncorrelate from market activity when it moves lower. So that doesn't mean negatively correlate because that's going to be a rough slog, but something that is designed to anticipate market dislocations like we've seen recently, which you consider can consider pretty minor because it was such a short duration decline. But also looking back over financial crisis, you need to have these things built into your portfolios from the beginning rather than sort of try to react and predict them.
Your performance avoided much of the move lower in the most recent bear market. How does Toews' price-reactive algorithm work?
Yeah, well, so when we initially launched these strategies, we looked back over the history of market declines. And what we discovered was that the anatomy of virtually every decline that's happened is first it moves down with low momentum, and then it picks up speed over time before you have crushing days or months or years. And so what we did is we built algorithms that attempted to interpret the very early stage of a decline. So the idea behind that is to attempt to be on the sidelines before major losses occur. And so what that looks like for us is it's a trend following algorithm that always has a sell signal below the market. And once the market, whatever asset class we're managing, moves below its target exit level, we have a delay parameter built in, and then we'll scale out typically over 3 days across our platform. So if you look at what happened in February and March, domestic equities moved out of the markets between February the 12th and the 18th, and then that got us out of the way of much of what happened in February and March.
Well, Phillip, a lot of models have a hard time knowing when to re-enter after declines. Toews' all equity models appear to have responded well during the bull-bear market transition. Can you explain how the strategy is built to protect client assets during the preliminary phase of market declines and rises?
Yeah, so what you don't want to do, and this is what everyone's tempted to do when they're trying to have strategies that are lowering risk, is attempt to predict the market. And you could do that by looking at fundamentals or even underlying technicals, or there could be some subjectivity involved. So what our price reactive algorithm is designed to do is to attempt to exit early. But then if the market does turn into a bigger downturn, then that target now becomes a target reentry price. And the longer the market moves lower and the further it goes down, then the lower that target reentry price goes. But then to just have a trend following algorithm then react as markets begin to move higher, that then we think adds a little bit more reliability around getting back into the markets. And so that's what we've seen historically, both in the internet bubble burst, in the financial crisis, and then recently during the decline in the first part of this year.
Are there funds that you manage that would allow investors access to this type of strategy that are accessible for investors?
Yeah, so the strategy you've been talking about is a separately managed account strategy that we've been managing, but we also have the Toews family of funds, and most of our funds operate based on the similar algorithms that attempt to exit and re-enter in the early phase of declines, and those are broadly available across different platforms and supermarkets. Yeah,
All right, Philip, great to have you with us. Thanks for joining me on Trade Talks.
great. Thanks, Jill.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.